Studies Section 11. Introduction to Company Account. Introduction. We have prepared accounts for sole trader and partnership. In this studies section, we will examine how to prepare accounts for companies. A company is a business owned by association of persons banded together with the usual motive of making profit. Objectives. At the end of this study section, you should be able to 1. Explain the peculiar features of a company financial statement and be able to prepare company account for internal use. And 2. Prepare journal and ledger entry for issues of shares and debentures. Pretest. 1. What are the peculiar features of a company financial statement? 2. Briefly describe the accounting entries for shares issued at a premium. 3. Clearly summarize the entries required for recording debenture issued at a discount. Content. A. Formation of companies. We can register a new company either as limited or unlimited company. There are two types of limited companies, namely companies limited by shares and companies limited by guarantee. In a company limited by shares, your liability is limited to your investment, while in a company limited by guarantee, your liability is limited to the amount of your guarantee. In an unlimited company, your liability is unlimited. In addition, limited liability companies are of two types, namely private and public. Before you can form a limited liability company, you need to file relevant documents with the Registrar of Companies. Two of these documents are Memorandum of Association and Article of Association. The content of Memorandum of Association includes the name of the company with the word limited at the end, the registered office, the objective of the company, a declaration that the liability is limited, the amount of authorized capital. The content of Article of Association includes the rights and responsibilities of shareholder, the duties and power of directors, how directors may be appointed, the procedure for accounting and auditing of the company's book. B. Peculiar features of a company financial statement. 1. Directors' remuneration and auditors' fees. This should be deducted before arriving at the profit before tax. 2. Share capital. There are various terms used in connection with share capital. Authorized capital is the total amount of capital stated in the Memorandum of Association which a company can issue out. Issued capital is the portion of the authorized capital which the company has issued to the subscribers, while called upon capital is the portion of the issued capital on which directors have called for payment. Paid up capital is the portion of the called up capital that the shareholders have paid for. 3. Taxation. Unlike other forms of business, companies are chargeable to tax in their own capacity. The provision for tax on current year's profit is deducted from the profit before tax. If necessary, you will make adjustment for over or under provision for tax in the preceding year's profit. 4. Appropriation account. This is the account where you share the profit after tax. Common items in this account include transfer to reserves, interim dividend paid, and proposed dividend. 5. Reserves. These are amounts set aside out of profits earned by the company which are not designed to meet any liability, contingency, commitment, or diminution in value of assets known to exist at the balance sheet date. 5. Reserves. These are amounts set aside out of profit earned by the company which are not designed to meet any liability, contingency, commitment, or diminution in value of asset known to exist at the balance sheet date. Reserve may be voluntarily created by directors, as in the case of sinking fund reserves and general reserves, or statutorily required as in the case of statutory reserves of banks. These reserves are transferred to the appropriate reserves accounts out of profit after tax when the final accounts are being drawn up. Other reserves are the direct result of capital incomes or surpluses earned by the company, which would not be included in the reported profit for the period, e.g., issue of shares at a premium. Reserves constitute part of shareholders' funds and may be capital or revenue. Capital reserves are not distributable to members in the form of cash dividends. Such reserves include share premium, capital redemption reserve fund, revaluation reserve, pre-incorporation profits, and profit on forfeited shares. Revenue reserves are distributable to members in the form of cash dividend. They include retained profit, debenture premium, profit on the redemption of debentures, and general reserves. 6. Debentures. A debenture is a written acknowledgement of a debt owned by a company, normally containing provisions through clauses on payment of interest and repayment of capital. Debentures should be disclosed in the published balance sheet under creditors. Amount falling due after more than 1 year unless they are due for payment within 12 months' time. 7. Proposed dividend. This is the amount of dividend which has been declared by the company's directors and approved at the annual general meeting by members. You should charge this amount in the appropriation account and show it in the published balance sheet under creditors. Amount falling due within 1 year. 8. Exceptional items. These are items which arise from the ordinary activities of the business but which are abnormal in amount. They are accounted for in the profit before tax for the period. 9. Extraordinary items. These are items of significant amounts which arise from events or transactions outside the ordinary activities of the business and which are infrequent or irregular in occurrence. They are accounted for net of attributable taxation under a separate heading, Extraordinary Items, in the Profit and Loss account immediately after the profit after tax figure. 10. Prior year items. When annual accounts are prepared, there must, as a matter of necessity, be a number of provisions raised for ascertainable liabilities, of which the precise amounts are not known. In the subsequent accounting period, when the actual figure becomes known, an adjustment is effected for the difference between the provision and the actual. If the item or transaction involved is of routine type, the adjustment is a prior year item. The adjustment falls in the accounting period in which it is corrected and not retrospectively into that to which it relates. The adjustment appears under the same heading as the original estimated figure. 11. Prior year adjustment. Certain errors, however, originating from an earlier period may be of such magnitude that they affect the validity of the account for that period by destroying the true and fair view basis. Errors of this type are termed fundamental errors and are accounted for as prior year adjustments. C. Final account for internal use. The content of the final accounts of a company for the internal use of management is subject to the dictates of the directors. For examination purposes, The final accounts for internal use are not much different from those of other business organizations except for the appearance of the peculiar items mentioned above. Example 1. The following list of balances was extracted from the books of Vicky Nigeria Limited as at 31st December 2004. 200,000 ordinary shares of 1 naira each. 200,000. 50,000 8% preference shares, 1 naira each, 50,000. 10% debentures, 50,000. Share premium, 8,000. General reserve, 10,000. Profit and loss account, 1/1/2004, 2005. Freehold premises, 150,000. Plant and machinery, cost 300,000 naira, 180,000. Stock 1st January 2004, 23,800. Purchases and sales, 281,600, 409,641. Returns inward and outwards, 10,300, 17,350. Discounts allowed and received, 6,450, 9,250. Debtors and creditors, 30,030, 20,020. Provision for bad debt, 1/1/2004, 905. Wages and salaries, 21,400. Postages and telephone, 5,800. Debenture interest, 3,000. Director's fees, 15,600. Insurance expenses, 2,000. Interim dividends. Preference, 3,000. Ordinary, 5,000. Cash and bank balances, 39,686. Interim dividends. Preference, 3,000. Ordinary, 5,000. Cash and bank balances, 39,686. Total, 777,666. Also, 777,666. Additional information. A. The authorized share capital of the company is 400,000 ordinary shares of 1 naira each and 100,000 8% preference share of 1 naira each. B. Stock on 31st December 2004 was 27,280 naira. C. During the year, goods worth 6,500 naira were lost to theft. No entry had been made in the books to reflect this. D. Insurance prepaid was 200 naira. E. During the year, a plant originally costing 50,000 naira and on which 30,000 naira depreciation had been provided was sold for 22,000 naira. This transaction had been included as sales. F. Depreciation has been and is to be provided on plant and machinery at 10% on cost. G. Provision for bad debt is to be maintained at 2,500 naira. H. The directors wish to provide for a final preference dividend, a final ordinary dividend of 5%. You are required to prepare 1. Trading, profit and loss, and appropriation accounts for the year ended 31st December 2004, and 2. Balance sheet as at that date. Solution: Vicky Nigerian Limited Trading Profit and Loss and Appropriation Account for the year ended 31st December 2004. Sales: 409,641. Returns inward: 10,300, making 399,341. On subtraction: sales of plant: 22,000. Net sales / turnover: 377,341. On subtraction: less cost of goods sold. Opening stock: 23,800. Purchases: 281,600. Returns outward: 17,350. Total: 288,050. Cost of goods stolen: 6,500. Cost of goods available for sale: 281,550. Closing stock: 27,280. Cost of goods sold: 254,270. Gross profit: 123,071. Add other income: discount received: 9,250. Profit on sales of plant: 2,000, making 134,321. Less expenses: discount allowed: 6,450. Increase in provision for bad debt: 1,595. Wages and salaries: 21,400. Postage and telephone: 5,800. Debenture interest: 5,000. Directors' fees: 15,600. Insurance: 1,800. Goods lost to thief: 6,500. Depreciation plant: 25,000, making 89,145. Net profit: 45,176. Appropriations: preference dividend, interim paid: 3,000. Proposed: 1,000. Ordinary dividend, interim paid: 5,000. Proposed: 10,000, making 19,000. Retained profit C/F: 28,646. Vicky Nigerian Limited balance sheet as at 31st December 2004. Fixed assets: freehold premises, cost 150,000. Account depreciation, nil. NBV 150,000. Plant and machinery, cost 250,000. Account depreciation 115,000. NBV 135,000. Total cost 400,000. Total account depreciation 115,000. Total NBV 285,000. Current asset: stock. Account depreciation 27,880. Debtors, cost 30,030. Provision for bad debt, cost 2,500. Account depreciation 27,530. Prepaid insurance. Account depreciation 200. Cash and bank balance 39,686. Current liabilities. Creditors 20,020. Proposed dividend. Preference 1,000. Ordinary 10,000. Accrued debenture interest 2,000, making 33,020. Working capital 61,676, making 346,676. Long-term liabilities 10% debenture 50,000. Net assets 296,676. Financed by share capital, authorized capital 400,000 ordinary shares of 1 naira each, 400,000. 100,000 8% preference share of 1 naira each, 100,000, making 500,000. Issued and fully paid capital 200,000 ordinary shares of 1 naira each, 200,000. 50,000 8% preference share of 1 naira each, 50,000, making 250,000. Reserves. Share premium 8,000. General reserve 10,000. Retained profit 28,676, making 46,676. Shareholders fund 296,676. D. Issues of shares. Shares can be defined as a unit of ownership of a company of a limited liability company. The two main types of shares are ordinary shares and preference shares. The ordinary shareholders receive dividend only after the preference shareholders have received dividend. The face value of the share as stated in the company's memorandum of association is per value or nominal value of the share. A company can issue share at premium or at discount. Issue price is equal to nominal price to issue at par. Issue price is greater than nominal price to issue at premium. Issue price less than nominal price to issue at discount. E. Shares issued payable fully on application. The accounting entries for shares payable in full on application is as follows. For shares issued at par, you will debit the bank account with the amount received on application. After allotment, you will transfer the balance in the application to the ordinary share capital account. If the share is issued at premium, you will transfer the premium from the application account to the share premium account. That is, you will debit the application account and credit the share premium account. If the share is shared at discount, you will debit the share discount account and enter the corresponding entry on the credit side of the application account. The application account is a memorandum account which will be closed up, that is, have no balance after all entries. Example 2. On 1st January 2000, the directors of Skidder Stick Limited makes an issue of 15,000 ordinary shares of 50 kobo at 1 naira 50 kobo. The money is paid fully on application. Application and the money were received for exactly 15,000 shares in February. The shares were allotted in March. You are required to show the relevant entries in the journal. Solution. Journal. February 2008. Bank account. Debit 22,500. Solution. Journal. February 2008. Bank account Debit 22,500. Application account being 150 kobo collected on 15,000 shares. Credit 22,500. March 2000. Application account debit 7,500. Ordinary share capital account being the nominal value of 15,000 ordinary shares allotted. Credit 7,500. March 2000. Application account debit 15,000. Share premium account being the premium on issued ordinary shares allotted. Credit 15,000. F. Share issued payable by installment. If the shares are payable by installment, you will split the memorandum account into application account as before, allotment account, first call account, second call account, third call, and final account. The actual number of accounts will depend on the actual number of calls. Example 3. Calling Nearity Nigerian Limited registers with an authorized share capital of 120,000 naira. The capital consists of 120,000 ordinary shares of 1 naira each. The shares were issued at 2 naira 50 kobo payable as follows. On application, 0.15 naira. On allotment, including premium, 1 naira 85 kobo. First call, 0.25 naira. Second call, 0.25 naira. All the shares were subscribed for and allotted, and all the cash were received. You are required to prepare the necessary ledger in the company's book. Solution: bank account. Application account A, 18,000. Allotment account C, 222,000. First call account F, 30,000. Second call account H, 30,000, making 300,000. Balance brought down, 300,000. Balance carried down, 300,000. 300,000. Application account, ordinary share capital account B, 18,000. Bank account A, 18,000. Allotment account, ordinary share capital account D, 42,000. Share premium account E, 180,000. Total, 222,000. Bank account C, 222,000. 222,000. First call account, ordinary share capital account G, 30,000. Bank account F, 30,000. Second call account, ordinary share capital account 1, 30,000. Bank account H, 30,000. Ordinary share capital account, balance carried down, 120,000. Application account B, 18,000. Allotment account D, 42,000. First call account G, 30,000. Second call account I, 30,000, making 120,000. Balance brought down, 120,000. Share premium account, balance C to D, 180,000, making 180,000. Allotment account E, 180,000, making 180,000. Balance brought down, 180,000. A. Amount received on application 0.15 times 120,000 is equal to 18,000 naira. B. Nominal application money on 120,000 ordinary shares issued 0.15 times 120,000. C. Amount received on allotment 1.85 times 120,000 is equal to 222,000 naira. D. Nominal allotment money on 120,000 ordinary shares issued 0.35 times 120,000. E. Share premium of 1.5 each on 120,000 ordinary shares issued. F. Amount received on first call 0.25 times 120,000. G. Nominal first call money on 120,000 ordinary shares issued 0.25 times 120,000. H. Amount received on second call 0.25 times 120,000. I. Nominal second call money on 120,000 ordinary shares issued 0.25 times 120,000. G. Issue of debenture. Debenture is a loan obtained by a company from investors through the capital market. Like shares, debentures may be issued at par, at premium, or at a discount. Unlike shares, debentures are normally issued in units of 100 naira. Accounting entries for the issues of debentures is easier because the memorandum account is not involved. The special peculiarity of debenture is calculation of debenture interest and preparing of debenture interest account. The basic accounting entries for recording issue of debenture are as follows. You will debit bank account and credit debentures account with the proceeds of the issue. If the debenture is issued at premium, you will transfer the premium from the bank account to the debenture premium account. That is, you will debit bank account and credit debenture premium account. If the debenture is issued at discount, you will debit the debenture interest account with the amount. You will enter the corresponding entry on the credit side of the debenture account. To record the interest paid, you will debit debenture interest account and credit the bank account. Example 4. Cofactor Nigeria Limited normally makes account to 31st December annually. The company issued 500,000 naira, 10% debenture stock at 95. Interest is payable half yearly on 30th June and 31st December. You are required to prepare the necessary ledger as at 31st December 2005. Solution. Explanatory note. The 10% attached to the debenture shows that the interest on debenture is 10%. The issue of the debenture at 95 shows that the debenture was issued at a discount of 5 naira per each 100 naira unit. The first interest payment on 30/6/2005 will be for only 4 months, 1/3/2005 to 30/6/2005. The second interest payment on 31/12/2005 will be for 6 months, 1/7/2005 to 31/12/2005. The relevant ledgers are as follows. Bank account 1/3/2005, 10% debenture 1. 475,000, 30/6/2005, debenture interest 3, 16,667, 31/12/2005, debenture interest 4, 25,000, 10% debenture account 1/3/2005, Bank 1, 475,000, 1/3/2005, discount on debenture 2, 25,000, discount on debenture account 1/3/2005, 10% debenture 2, 25,000, debenture interest account 30/6/2005, bank account 3, 16,667. 31/12/2005. Bank account 4, 25,000. 1. Amount received is equal to 500,000 times 0.95 is equal to 475,000. 2. Discount on debenture is equal to 500,000 times 0.05 is equal to 25,000. 3. Interest paid on 30/6/2005 is equal to 500,000 times 10/100 times 4/12 is equal to 16,667. 4. Interest paid on 31/12/2005 is equal to 500,000 times 10/100 times 6/12 is equal to 25,000. Summary. A company is a business owned by association of persons banded together with the usual motive of making profit. Before you can form a limited liability company, you need to file relevant documents with the Registrar of Companies. Two of these documents are Memorandum of Association and Article of Association. The final accounts of a company for internal use are not much different from those of other business organizations, except for the appearance of the peculiar items like directors' remuneration, auditors' fees, share capital, taxation, appropriation account, reserves, debentures, dividend, exceptional items, extraordinary items, and prior year items. A company can issue its shares and debenture at par, at premium, or at discount. This is the end of Studies Section 11. Thanks for listening.